Okay, good evening, everyone. Stephanie is back. This is the third time, the third episode that she will be talking about SBA funding. Many of you already know her. She is with Hanover Bank. We're doing a lot of deals together, and hopefully we can get a restaurant $5 million deal closed by the end of the month. We're looking forward for that. So tonight, Stephanie is going to be talking about how to for SBA acquisition. So again, without further ado, Stephanie, the floor is yours. Let us know what you got.
Thanks, Alan. Good evening, everyone. Again, my name is Stephanie Thomas from Hanover Bank. Today, I'll be walking you through SBA Business Acquisitions 101 with a focus on deal structuring and how credit evaluates these types of transactions. The goal is to help you better understand what makes a deal approvable and ultimately successful. So let's start with how credit thinks. At the core, the primary question that credit has is simple. Can this business repay the loan with a margin of safety? Cash flow is king. Everything revolves around that. Credit decisions are based on a combination of the deal structure and the borrower's strength and overall risk. The key matrix here is debt service coverage ratio. Typically, lenders look for a minimum of 1.25, but 1.4 or higher is considered very strong. It's also important to note that lenders use adjusted cash flow so that they remove any weak add backs and often discount projections to stay conservative. Next is leverage and global cash flow. Most lenders target leverage between 4.0 and 4.5. Anything higher requires a very strong borrower profile. We also look at global cash flow, meaning we consider all debts, both business and personal. Affiliates or related businesses can also impact the approval, especially if the affiliate is underperforming. The standard deal structure, a typical SBA deal structure for business acquisition includes 70 to 80% SBA financing, 10% buyer equity, and 10 to 20% seller note. This structure helps balance between the bank, the buyer, and the seller while also covering the purchase price and closing costs. Optimal structure example here would be for $1 million deal, you might have a $800,000 loan from the SBA, $100,000 from the buyer, and $100,000 as a seller note on standby. This structure reduces the buyer's upfront cash requirement while still meeting the SBA guidelines. Asset versus stock purchase. When it comes to structuring a business acquisition itself, asset purchases are generally preferred by the bank. They limit liability exposure and they provide cleaner collateral. Stock purchases, on the other hand, require more diligence because the buyer is inheriting all the liabilities, known and unknown. Seller carry rules. Seller notes are a key part of many deals, but they must follow strict rules. Typically, they need to be on full standby for at least 24 months, meaning no payments during that period. If the seller note counts towards equity, however, then they must be on full standby for the life of the loan. The benefit to a seller note is that they can count towards the buyer's equity, and they do help reduce the buyer's cash injection, helping with post-closing liquidity. Earnouts and holdbacks. So earnouts and holdbacks are also common, but they serve different purposes. Earnouts are tied to future performance and don't count as equity. Holdbacks are used for contingencies like unresolved issues. Important to note that neither of these can replace the required equity injection. Earnouts or performance-based payments. An earnout is money the seller might receive in the future, but only if the business hits certain targets after the sale. For example, the buyer agrees to pay $5 million up front plus up to $2 million over 2 years if revenue or profit goals are met. Why it's used, it bridges the valuation gap. So if there's a disagreement on the value between the buyer and the seller, it protects the buyer from overpaying, incentivizes the seller to help the business succeed post-sale. And then this is not guaranteed money, so lenders do not count it as equity. For holdbacks, basically risk protection. A holdback is when part of the purchase price is temporarily withheld after closing. For example, the purchase price is $5 million. The buyer pays $4.5 million at closing, holds back $500K for 6 to 12 months. That's used typically to cover risks like undisclosed liabilities, pending legal issues, or inaccurate financials. If nothing goes wrong, then the seller eventually gets the money. The whole key point of this is part of the purchase price is just delayed, but it's still not equity from the buyer. Goodwill and valuation. Goodwill is often one of the biggest risk factors in a business acquisition deal. It must be supported by strong, consistent cash flow. High goodwill means higher risk, and lenders often require independent business valuations. Overpaying for a business is one of the most common deal killers. So if you have a business valuation come back low, that's going to be a deal killer. And typically that's when the seller and the buyer have to go back and renegotiate the purchase price. Quality of earnings. Quality of earnings is critical. Add backs need to be legitimate and well documented. Future or unproven savings should be removed. Lenders also analyze trends, margins, and consistency. So stable performance builds confidence with the lender. Oh, I think I might have missed a slide here. Oh, here we go. Borrower profile. The borrower themselves is just as important as the business. So lenders prefer usually 5 years of industry experience. They want to see that the borrower has strong liquidity, typically at least 10% post-closing. And they also would like to see management continuity. So a weak operator significantly increases risk, even if the business looks strong on paper. Common deal killers. There are several common reasons deals don't get approved. Some of the common reasons are active litigation, low debt service coverage ratio, too much leverage, unsupported add backs, declining revenue, lack of experience, or weak post-closing liquidity. So those are red flags lenders look for right away. Advanced structuring strategies. For more complex deals, there are advanced structuring strategies that can help. For example, seller standby to reduce equity requirements, partial buy-ins, partner or operating models, roll-up strategies, and combining real estate with the business. That makes the deals more flexible and more attractive to the lenders. Another strategy that I've seen when there's a lack of industry experience, if there is a manager that is staying on that has been running, managing the business for an extended period of time, sometimes giving them a small percentage of ownership in the business so that gives them incentive to stay on at the business, giving them 3-5% ownership in the business, that also can give the lender more security that, management is going to stay in place.
Stephanie, if you don't mind, can I jump in, ask you a question
Yeah,
real quick? I
sure.
forgot. So you mentioned about that. That's a very good point right there, where the management team is going to stay. Now, is it necessary for the clients to give them the ownership? What if they decide not to give them the ownership, but let's say, sign an employment contract for the next 3, 5 years? Would that
Mhm.
would that help?
That would help. I have seen this happen a couple of times where the bank comes back and says, this we like this deal. However, the borrower doesn't have any management experience or any industry experience. So we would feel more comfortable if there was some sort of security that the management is going to stay, because basically without any kind of management or industry experience, if the existing management were to walk away at any point in time, then we wouldn't feel comfortable with the deal. So that's been some structure I've used in the past to say, hey, he's given the existing manager 5% ownership in the business, so that manager is not going anywhere.
Mhm.
So just a thought process just to mitigate that risk.
Mhm. Can you explain? Can you go back to the previous slide?
Sure.
Can you explain what is rolled up strategies?
So rolled up strategy is basically where um, you can take trying to think of the best way to explain this. So if you take existing equity in the business and you roll that into um, the business acquisition, you can roll a portion of that into the business acquisition. Um, Sometimes whenever there is issues with um, the borrower equity or post-closing liquidity, we can structure. It's rare, but sometimes we can write that into the structure to try to mitigate those, post-closing or equity issues.
Okay. You mentioned about post-closing liquidity. So normally,
Mhm.
how much are you looking for?
So post-closing liquidity, we want to see 10% of the loan amount after the borrower makes their 10% equity injection. So what we don't want to see is a borrower that puts in their 10% equity injection and then they have nothing, no cash left. Another tip there to keep in mind is a lot of times when you look at a borrower's PFS,
Hmm.
you'll look at, most borrowers don't fill out their PFS correctly.
Hmm.
So a lot of times there are other assets like treasury bills. Those are considered liquidity. But if they lump those into stocks and bonds, you may not even realize they have that asset.
Hmm.
I just had that happen recently where a borrower lumped his treasury bills into his stocks and bonds. And so it looked like he only had 2-3% post closing liquidity, but he actually had over $200,000 in treasury bills, which counts towards liquidity. So actually, his post closing liquidity was phenomenal.
Mm.
You know, so if you have that issue where it looks like a borrower doesn't have enough cash up front, then you definitely want to ask more detailed questions about their assets, especially what's included in their stocks and bonds, just because it may just be that they need to be recategorized on their PFS to show that they have stronger liquidity.
So when you're talking about liquidity, you're looking for something that can liquid pretty quickly, such as stocks and bonds, and you would not count 401k, IRA, that type of asset, right? Do you?
No, not unless they were willing to liquidate uh, retirement funds. And then we would also calculate in any prepayment penalties that would apply to that.
Right. And oftentimes I see people when they fill out the PFS, they also put in stock value for some of the company that they own. I would imagine you would not count those neither, right?
No, we wouldn't count that as
Right.
liquidity.
Okay. Understand. And can you touch more upon partner and operator model? What does that mean?
So basically, that is what I was talking about. Where, well, sometimes, like I said, they make a key employee or manager a partial owner to keep them on. So, they've been successfully managing, operating the business um, over, extended amount of time, usually several years. And we want to give them some sort of incentive to stay on. So that's more where that comes in.
Mm,
Um, is, trying to give an incentive to keep current management or key employees in place just to minimize risk,
mhm.
if the buyer doesn't have adequate management or
Mm,
industry experience.
okay. Thank you.
So winning the credit story. So beyond the numbers, the narratives matter. You need to clearly answer questions like why this buyer, why this business, why are they wanting to buy this business now? And then also, how's the risk going to be mitigated? So, a strong backstory is really important. Knowing your deal, knowing the borrower, being able to explain their background, their industry experience, their management experience, even if their management experience is in a different industry. Having people skills and showing that you can manage people is a really strong point. I would almost rather see people management skills over industry experience, because managing people across different industries is really, requires the same skill set.
Right. So we actually have a case. This is a real case that we are discussing with Stephanie right now. So we have a client that owns um, of about approximately 10 different locations for um, Chinese medicine type of business. And now he wants to purchase a plastic company that produce plastic bags, right? So again, we were discussing with Stephanie about the doable of this particular deal right here. So Stephanie, if you don't mind, can you share with the audience that our conversation and how you see this deal in terms of the
Yeah,
experience wise and yeah.
yeah. So it's my understanding that he did have experience in manufacturing previously.
Uh, well, we're talking about different buyer now. Remember that buyer does not have
Oh,
the
okay.
right. He doesn't have the citizenship, so we cannot use that buyer. So we replace another buyer who
Mhm.
owns 10 different locations, and he owns the business. So he has the experience of managing a business, but he does not have the experience in the plastic manufacturing
Industry.
industry, right?
Right. So, but the key management is going to stay in place. So
Mhm.
that was a big factor. So we talked about that, about
Yep.
how um, that can really make or break a deal if your key employees and management are going to stay in place post transaction. That's a key factor. And then also showing that he has the equity injection available.
Mhm.
And then we talked about post-closing liquidity. We want to make sure he has 10% post-closing liquidity.
Yep.
Um, so those are really some key factors
Mhm.
that we want to look for.
Correct.
So overall, it sounds like a strong deal. And,
Right.
not having any major credit issues, of course, having a minimum 680 credit score, not
Mhm.
having any recent collections, bankruptcies, tax liens, criminal history, that plays a factor into character issues. If someone has a borrower had, a DUI 20 years ago, that generally doesn't make or break a deal, but those are definitely questions you want to ask up front.
Right.
Uh, Another common thing that I see a lot is borrowers will be involved in active litigation.
Mm.
Even a divorce counts as active litigation. So that's a question as a broker that I would ask up front. I just had a couple of deals that um, I was working on. They were really strong deals. Come to find out later on when we ran the background report and ran all of the searches that were required by the SBA to run,
Hmm.
they had both of these deals had active litigation that they were currently involved in. So it was an automatic stop. We can't do anything until those cases are settled. So those are just some things to keep in mind.
Is that a SBA rule or is that just for Hanover Bank?
It's a SBA rule.
Okay. Got
Yep.
it.
Just because even, with the divorce, when you're evaluating risk and you're looking at some business's assets, or, if a borrower is involved in, say, a divorce, you don't know what their assets are going to look like after that divorce. So their financial picture could change a lot um, after that proceeding is settled. So that's why we can't move forward when there's active litigation. We want it to be completely settled and case closed before
Mm.
we move forward. So,
Another question is, what if they already have SBA loan with their current business and now they want to buy another one? Can they still
mhm.
qualify? Or if they do, how much they can qualify?
so it depends on the size of their current SBA loan. So there's an SBA guarantee. It goes
Mhm.
up to $3.75 million. So it's the guaranteed portion of the loan. So the SBA guarantees for a 7A loan up to 75%. So it's not the total loan amount, it's based off the 75% guarantee. So, for example, let's say you have get my calculator up here. Say you have a $5 million loan. Um, So 75% of that would be 3.75. So you'd be maxed out on your SBA guarantee. That borrower would be maxed out. They can't get another SBA loan until that loan is paid off. But let's just say, the borrower has a $500,000 SBA loan. The 75% guarantee on that would be $375,000. So
Mhm.
they still have up to 3.75 and guarantee money before that they can't they're capped out and they can't borrow anymore from the SBA.
Mm. Got it.
So it's not the full loan amount, just the 75% of the loan amount that up to 3.75.
Understand.
Yeah. So you could get multiple SBA loans as long as you haven't maxed out your SBA guarantee
Mm.
and your cash flow supports it. That's the other thing, is your cash flow has to support um, the additional debt,
Right.
existing and additional debt.
Mm. Okay. Thank you.
Yep. So an example of a green light deal, a green light deal typically includes DSCR of at least 1.25, an experienced borrower, 10% equity injection, a seller note component, strong liquidity, a credit score of at least 680 or higher with, like I said, no major recent issues. And that's ideally what the lender is looking for. And like I was saying, seller notes are a good tool to use if there's issues with, the seller doesn't, or the buyer doesn't have enough cash to meet their equity requirement. You can use the seller note to use towards equity, but just keep in mind that if the seller note counts towards equity, then it has to be on full standby for the life of the loan.
Hmm.
So final takeaway, strong deals come down to three things: structure, cash flow, and risk control. The most important thing is not just the numbers, it's also the narrative and how you present the loan. Well-structured deals with clear, compelling stories get faster approvals with fewer obstacles. And with that being said, I just want to say thank you, and I'm happy to answer any questions that anyone has.
Hmm. Yeah, feel free to unmute yourself if you have any questions. I see Elvis as a question right here. Can I attempt to bring in a friend with plastic experience and maybe come into the picture and steal the deal, depending on the situation? Would that be a possible look into? Yes, absolutely. I mean, again, I would think so, right? Stephanie, if you can address that regarding to that plastic a deal that we talked about.
Yeah, so that would be possible.
Yep. I do have some questions right here. Feel free again.
Mhm.
You can either ask your question in the chat box or unmute yourself and feel free to ask, right? So, my first question is that oftentimes we have clients come to us saying, "Hey, Alan, I want to buy a business, um, but I don't know how much I can qualify for." So, uh, what would you suggest us to? How would you suggest us to respond to that questions? Do we need to look at their tax return first, and or is that a rule of thumbs that we can use to give them an estimate how much they can qualify for?
Well, I do think that it's good to have some kind of Excel template that you can do a quick cash flow analysis, because that's what most BDOs do. That's the first thing I do. I want to see 3 years of tax returns, and I want to see an interim statement. So like right now, a lot of borrowers don't have their 2025 tax return back. So I'll ask for their 2025 year-end statements. And, you can run a possible scenario on the loan amount to see how much they would qualify for based on their cash flow coverage. So that's the first thing I do. And I want to see ideally that they meet the 1.25 DSCR for the last 3 years um, based off the proposed loan amount. So the formula is basically, their net income um, against the annual payment of
Right.
what the annual loan payment would be. And so, if it's real estate, it's going to be based off 300 months. If it's a business acquisition or working capital, it's going to be 120 months.
Hmm.
So, if you're not using some kind of a basic Excel spreadsheet to do those calculations, I would highly recommend that, because that's what I do as a BDO. And I can, you know, but basically, a good rule of thumb, if you're just trying to quickly do it based off viewing a tax return, if you can calculate what their annual payment would be on the loan amount that they're requesting, when you look at their net income, if it's negative, then you're going to have a problem. I'm right off the gate. If I see a negative net income, we add back interest and depreciation, but most often than not, if they have a negative income, they're not going to meet cash flow requirements.
Hmm.
You basically want to show that their net income can at least um, cover their annual debt payments. So if they're not making enough net income to cover their annual debt payments, they're generally not going to meet cash flow requirements, even with add backs. So sometimes, there can be cases where there's extraordinary expenses that they had one year that can be added back. But as a general rule of thumb, if you're just, you don't have time to do a cash flow analysis, you're just doing it off of viewing the tax return real quick, even their 2024 tax return, if they have a negative net income, they're probably not going to meet debt service coverage ratio.
Mm. Well, I think in another way, I heard, I haven't tried it myself yet. Probably
Mm-hmm.
I would try it myself. They're saying that, hey, if you receive the tax return in a PDF format and you dump into ChatGPT and
Mm-hmm.
ask the AI saying that, hey, this is the tax return, and based on this, how
Uh-huh.
much this client can qualify for, and somehow they were just able to read through the documentation and give you a number. Probably that's a worth a try for everyone. Just a
Yeah,
thought.
yeah, that may work. There's a lot of software out there too that you can upload the tax returns, right? Like our software,
Yep.
we use Abrigo at the
Hmm.
bank. Um, we actually have a feature. If you upload the tax returns, it'll automatically spread them for you.
Right.
I don't like doing it that way. I like doing it the old-fashioned way because I like to look through
Right.
all of their expenses and analyze. I guess I come from a credit background, so
Right.
I like to analyze all the statements and look at, all the expenses um and just make notes as I review the tax return on
Mhm.
questions that I have. Um, but that's, I'm always looking to see what can I add back? Looks like an unusual expense that I don't see
Mm.
repeating from year to year.
Mm.
Because there are opportunities if an add back is reasonable and it can be documented, sometimes that can make the difference between you meeting cash flow requirements or not.
Right.
So I think it's really important. But there's a lot of really great AI tools out there now, and they're starting to implement those
Hmm.
into a lot of software that, credit and banks use just to shorten the process so it's not such a manual process. So I definitely see that coming in the future.
Absolutely. Absolutely.
Hmm.
So Raymond is asking, can buy a farm using SBA loan also 10% equity injection?
Yeah, so you can use the 7A program or you can use the USDA program. The USDA program is a much longer process because you have to have it approved through the bank and then it has to go to the USDA and have it approved as well. But some banks will, especially if it's a higher risk type of transaction, they'll use the USDA because we actually have a higher guarantee percentage through the USDA. So instead of a 75% guarantee, we can get an 85% guarantee.
Mm.
So sometimes banks will use the USDA program just if it's a riskier transaction. Um, but the other issue with that, I mean, most farms are located in rural areas, so that's generally not an issue, but it still does have to qualify for rural development. So there's a map that we use. We plug in the address, and it'll tell us if it qualifies for USDA or not. But yeah, you can definitely you can buy a farm with 10% down.
Okay, great. Um, there are times that, coming back to the business acquisition, sometimes the client is buying not just the business, but also purchasing the real estate at the same
Hmm.
time.
Hmm.
So let's say the entire transaction, it's $5 million, for example. So
Hmm.
how do you evaluate what, how much of that $5 million goes to the real estate, how much of that $5 million goes to the business. I would imagine that you need to obviously you need to do an appraisal
Mhm.
on the real estate. So is it normally that how the bank evaluate the deal?
So yes, so in the purchase agreement, it should be broken out. And if it's not broken out, we'll go back and ask specifically that it's broken out. We want to see um, what is the purchase price for the building versus the business, what the intangibles are, um, what the goodwill is. We want all of those figures broken out in the purchase agreement so we know up front what those figures are. And then also we will, as a part of the approval, we'll order an appraisal. We'll also order a business valuation because we want to make sure that we're having those figures verified by a third party. And so if the appraisal or the business valuation comes back low, then that's where either the borrower has to come in with a higher equity injection or they have to negotiate a lower purchase price with the seller.
Right, understand. George is asking, by the way, George is our VP of origination. So he,
Uh-huh.
by the way, he's also a lender himself. So
Okay.
George is asking on an average, how long does it take to close an SBA loan?
So that depends on the type of transaction that you're closing, and it does tend to vary from lender to lender. At Hanover, it's generally 30 to 45 days, depending on if it's a real estate transaction or if it's a business acquisition, if it's a um, startup franchise where there's leasehold improvements. Generally, real estate transactions take the longest because you have to wait for third party reports like appraisals, environmentals. Um, so we're always at the mercy of third party reports. But mostly it tends to come down to the borrower. I've had borrowers that are very motivated. They get you documents right away. And then I've had other borrowers that, may take a few weeks to get, documents to you. So we can really close deals quickly if we have all the documentation from the borrower that we need in a quick, timely manner. But in general, it's 30 to 45 days. Um, and then also some of the larger high volume lenders, they tend to take longer because it can take 3-4 weeks for them for your request just to get through underwriting
Mm,
because they do such a high volume of deals that their pipelines are really backed up
mhm.
and they will underwrite credits in the order that they're received. So you may be sitting in a pipeline for 4 weeks before you're assigned to a credit analyst to even start the underwriting process. I just ran into that issue not too long ago. I had a borrower that they were on a real time crunch. They were trying to purchase a piece of real estate, and they actually had a term sheet with a lower rate from a larger lender, but they went with Hanover because our underwriting process is a lot quicker.
Yep.
Um, and they couldn't wait 4 weeks for, the larger lender to underwrite their loan. So that's something to keep in mind too when you're referring a borrower to a lender. Be sure to ask, how long's your underwriting process taking right now? Because during busy times, lenders can really get backed up,
Right.
and you may have submit a really great loan package and have all the documents up front, but because their pipeline is so backed up, especially the larger high volume lenders,
Mm,
the underwriting process alone could take 4 weeks.
mm.
So that's just something to keep in mind.
Great insight. Um, let's talk about constructions. Like for example, like the one that we are working on right now. Hopefully, you can get it closed this month.
Mm-hmm.
It does have the construction component to it. So when SBA fund this type of loan, do you fund based on draw? Like normally on a construction deal, you have a draw schedule, right?
Mm-hmm.
So for something like this, do you fund it as a based on draw schedule, or you will give them the lump sum?
We do it on draws. So they'll get an initial working capital disbursement up front at
Hmm.
closing, but then it'll be, we'll have and most lenders do it this way. There's a dedicated construction team that handles leasehold improvements or renovations, construction, ground up construction. Um, but the team will manage that project. So basically, they'll work with the contractor and the borrower. So when the contractor is ready to complete a certain component of the project, they'll submit the invoice uh, to the construction team, and then they'll disperse the money for that particular part of the project. So it'll be in draws. And generally, that's when we set the interest only period based on the contractor's estimate of how long, the renovation's going to take, 5 months, 6 months, 12 months. Um, so yes, it's construction projects, whether it's leasehold improvements, ground up construction, or renovations to an existing building, they're all dispersed in
Draw schedule.
draws.
So I would imagine that you are paying the contractor directly, right? That fund, you will not pay the fund to the client.
Right.
So that leads to my next question. So understand that a lot of time when they request a fund, that loan amount including, for example, like inventories, purchasing
Mhm.
equipment, so on and so forth. So do you pay the invoice directly and pay to you do not pay to the client directly, right? In that cases,
Right.
those cases.
We pay the invoice. We pay the contractor or the vendor directly.
Okay, great. Wonderful. Understand. Mark is asking another question right here, saying that he has a client buying some sort of land. Um, after a purchase is going to be 90 acres. Would he be better off getting a traditional loan, or would he be better off get a better deal if he buys it as agricultural? I believe it's the use of land because we have done a lot of land loans. Probably George, if you can jump in also if you're online. But we George has funded a lot of land deal in the company. We need to understand what that land is for. Is it just for agricultural or is it purchasing for constructions? Um, what is the purpose of the land? Then we can decide how to put the deal together. George, if you're online, would you like to chime in?
Yeah, absolutely. And Alan, you're 100% right. It depends on the use. When we get a land request, we always ask what the intent is because a lot of lenders, they want to see a clear exit strategy and they don't want to hold land for a long time. And so once they have a clear picture as to what's going to happen and what the person's going to do with the land, then we have a much better chance to get that funded. So they'll ask questions like what has it been subdivided? Has it been engineered? Is it ready to go? If not, then what needs to be done? What's the zoning and all these questions? So once we have a clear picture as to what the strategy is, we'll be able to definitely help out once we know more.
Right. Thank you so much, George. Now, my understanding is that for land,
Mhm.
because land in general does not produce any income. So there's no way for you to do any calculation based on DSCR. So a lot of these land deal are short-term deals. We experienced the longest term that we ever funded a land deal, it's 18 months, I believe, because a lot of our lender do not want to, they're not going to be able to give you a 3-year, 5-year, 10-year deal. a 10-year note on a land that they don't know what you're going to do with it. So they want you to, you know, have an idea how to exit. The exit strategy is very, very important. But from the SBA point of view, Stephanie, do you have any advice on land?
Well, uh, for SBA, obviously they want to know what the use of the land is going to be, and it has to be generating income. So generally, if you purchase land, it has to be part of a bigger project, as in ground up construction. You're building a building for your business, you're building a hotel, a manufacturing plant, and then the other issue that you want to keep in mind with the SBA is they don't like excess land. They want, so if say you were going to purchase 90 acres and you're only going to use an acre for, you're going to build a building and you're going to use an acre um, for your business, they don't like that. They consider that excess land, because what can end up happening is after the initial transaction, then you have borrowers parceling off that excess land, selling it,
Yep.
and then you have collateral issues with the SBA, because as long as the SBA has a lien on that property, you can't do anything with it. You can't section it off. You can't sell it, because it's a part of the collateral. So that's something to keep in mind with the SBA. They don't like excess land. They want to be sure, if you're purchasing, a property with several buildings, on the same plot of land, and you plan on using at least 51% of those buildings, 51% of the square footage for the business, and you want it to lease out, 49% of that property, that's allowed. But the 51% occupancy rule would still apply there. I've seen that happen where a borrower will purchase a plot of land with multiple buildings on it, use, two of the buildings for their business, and then rent out, lease out the other building. Situations like that, as long as they're meeting the 51% occupancy, owner occupancy rule, then you could do something like that.
Mm.
So just something to keep in mind.
Okay, great. Well, thank you so much. Um, well, I'm asking the last question then. So, Stephanie, thank you so much for all the information. Now, in your bank, what are you seeing this year? I know there's a lot of things happened since the beginning of the new year. Interest
Mhm.
rate has been ups and down. The obviously there's the conflict in the Middle East. The oil prices
Mhm.
goes up, and a lot of things happening. So, what are you seeing in your bank? Are you guys busy, or what do you see? What type of deal you fund you're funding? Can you share with us what you're seeing?
Sure. So I still see a lot of deals coming in. Uh, March is always a busy month. I feel the end of each quarter is always really busy. I see a big influx of loans come through.
Hmm.
I think because most borrowers are looking at their financials for the end of the quarter, and they realize that they need working capital.
Hmm.
But I'm still seeing a lot of real estate deals coming through.
Yep.
Um, Still seeing some franchise
Hmm.
startups, franchise acquisitions, um, some business expansions. A lot of banks, though, are, tightening up their credit box right now because of the conflict in the Middle East,
Hmm.
and just the uncertainty in the economy right now. Um, all of the political issues that have been going on over the last, several months. So I expect, things to open up more maybe in the fourth quarter. Um, but I stay busy. I don't have any real major concerns. about any specific
Yep.
industries. Each lender is different. Their credit box is a little bit different and their portfolios look different. Just I think a key to keep in mind is just because one lender decides to stop lending to one specific industry doesn't necessarily mean there's a problem with that specific industry. It just may
Yep.
mean that they have a concentration in their portfolio of that industry,
Hmm.
not so much that, oh, we want to stay away, everybody wants to stay away from that particular industry. That particular lender may have recently had some losses in that particular industry or a specific type of transaction, so
Hmm.
they want to stay away from those particular types of transactions. But I feel good about
Hmm.
I feel good about what I'm seeing. I'm
Great.
not really concerned.
Yep.
So
Well, same here. I mean, like ever since the beginning of the year, Sequoia has been very, very busy.
mhm.
George, if you're still online, I know that you guys are very busy in the back. So if you don't mind, can you share with us what are you guys doing, George? Not sure if George is still online. George, if you're still online, you can unmute yourself and let us know that
Oh,
where you
sorry.
are. Yeah,
Sorry, I was on mute. You
sure.
we want me to explain what we're doing on on
Yeah,
the
just let us know that, about our workflow, things like that in the, what in your department.
yeah, we've been real busy, to your point.
Yep.
We've been really busy. We've seen a good volume of DSCR, small balance commercial, fix and flip, and so cash out refis on the bridge side. So we've been pretty busy. The geopolitical stuff. I mean, I know it's going on, but as far as on the real estate side, it's nothing has slowed down. Everything's still active and opportunities are out there. So we've been extremely busy.
And I know that you're working with a few builders such as Yan and they, talk about those. I mean, there's a lot of construction deals going on in our back office.
Yeah, absolutely. I mean, from single family homes, just the single lots. We're working on a couple, literally single family, just was one lot, one home, to a developer we're working with, as Alan mentioned, that's doing 100+ deals, 100+ properties, 100+ lots, with the purchase order to buy some more. And so that's been pretty exciting when you look at what's going on. These are again from single family all the way to very complex type deals on the construction side where we have the developers and we're actually helping them on the single flicks on the single stuff. We can get them money for the construction side. On the other side, we're actually getting money for the A&D, which is acquisition and development. So it's a whole different animal, but still we're able to help. And that's really you're talking about large numbers.
Yep.
On a single family, you got one property, the construction, not just a modest loan. On the A&D side, it's in the multi-millions of dollars.
Yeah, absolutely. I mean, again, that's what I'm seeing on my side also. So George dealing with a lot of the construction side. Probably many of you also know in Sequoia's platform, we do have many other product and services. So besides of the commercial funding, we see in terms of property restoration, okay, please keep in mind property restoration. Right now, currently in our pipeline, we have over 70 properties. It's in insurance claim right now. So that is huge amount. Based on those 70, the all the volume add together, we're talking about at least in the $1 billion claim right now in restoration. So again, if you know anybody, their commercial property or not even just commercial, any residential or commercial property got any natural damage, such as wind damage, water damage, whatever that might be, we have a team of specialists right here that definitely can help them to claim a lot more claim than if they would do it by themselves. And we're also promoting heavily on the wellness program. And again, we have consultants right here working with company that has hundreds, 200, 500,000 employees. So that is very busy for us as well. Personally, and I have been working with our investment fund. Many of you already know we bought in a fund in February last month. It's a $5 billion fund from Qatar, and currently, right now, we have over 10 different projects, and all those 10 different projects add together. close to $1 billion. I think it's like 850 million dollar worth of investment so far. So again, we have a lot of money to deploy this year. So absolutely, we are very, very busy, and I hope that you are busy also in this room. If not, then hey, go out there. There's a lot of opportunity out there. People are still hungry for money, regardless what the economy looks like, right? So again, that's all I have, and thank you so much, definitely, for another wonderful training, and looking forward to see you again in next month in May. Okay,
Yep. Sounds
everyone
great.
else.
Thank you so much.
Yep, absolutely. Well, thank you everyone for another wonderful night. And until then, we see you guys next Wednesday. Good night, everyone.
Have a good night.
Bye bye.
Thank you.
Good night.